We're going to continue this conversation now. For more on the outlook for home buyers and mortgage rates in particular in the new year, we're joined by Jeff Taylor, founder of Mphasis Digital Risk. Jeff, I don't know if you heard that conversation, but Katie was talking about, 6 or 7% mortgage rates right through the next 2 years, potentially beyond 2026 even. Do you agree with that, given that we're now expecting even less than 2 Fed cuts next year?
Well, thank you very much for having me, and Happy New Year. If you look into 2025 right now, here's what we know, right? We're going into the market at around 7% right now. We hit a low of 6 1/8 around September. If I look at 2025, I really am looking for the 30-year fix to be around 6 and 6.6 going into the end of the first quarter, and I think by the end of the year we're going to be at 6.3. But here's another thing: we have a new president coming into office, and there's definitely going to be some volatility going on as far as potentially with rates. So I don't know where rates are going to be in 26, but in 25, I think you're going to see somewhere between 6 and 6.5 on the second half of the year.
What's more important, though, at this point? Mortgage rates or housing supplies and supply-demand kind of imbalances when you look at what's to come for housing in 2025, Jeff?
It's a great question, right? And they're definitely correlated. The good news on the supply side is from the home builders, we have around 490,000 new houses that are on the market right now. That's up 8.9% from this time last year. In the existing home market, we have 1.3 houses on the market right now. That's up 17.7% from last year. So we have a decent amount of inventory, and the home builders are definitely leading the way by creating new. So you couple that with probably a 6.3 to 6.5% interest rates. And if people really want to go ahead and buy, they're going to make that life decision to go ahead and do it. Because the affordability is not nearly as bad as a lot of the headlines have talked about. For instance, if you put 5% down on a house, that's about $400,000, a rate of around 7%, a family joint income of $115,000, $600 in other non-mortgage related expenses, you can afford that house. So it really also comes down to when do the people feel comfortable with their job at that time in their life to go ahead and make that home purchase.
We talk so much about the American dream, though, and then every now and then the idea comes up that maybe the American dream is changing. Maybe home ownership isn't part of that so much anymore, like it isn't in many countries in Europe, for example. Is that a possibility? Is it a possible outcome that Americans won't tie their identity to the home that they own?
Right. Again, another really good question. We see a lot of people buying later right now, still living at home. If you look about creating, wealth or security for your family, I still think there's nothing better you can do than buying a home, making those payments to create sort of that nest egg. I still think that the American dream is to be able to come here and own a home, because unlike many other countries, we have a program in place, right, with Freddie and Fannie and a mortgage finance system that allows people to be able to come in and put 3%, 5% down on a house. I don't think there's anywhere else in the world that allows that. So in coming to America, I still think the number one thing that people are focusing on is eventually to have the American dream, which is buying a home.
You have a lot of data that comes across your platform in terms of what you do. And again, we say, you've got a unique vantage point. So I am curious how sensitive or how much sensitivity you continue to see potential home buyers, whether it's because of mortgage rates, whether it's economic news, whether it's Fed policy. Just give us some insight based on the data points that come across your desk and your platform.
No, and thank you. And at Digital Risk, we do have a unique insight. We're working with one of the largest banks in the country, and the GSEs and home buyers. So what we're seeing right now as we kind of go forward is the housing structural system is very, very solid. And this has been great over the last 15 years of putting loan products out there that people can afford and people can buy. Where rates are obviously volatile and they fluctuate, but right now we think that the housing market is extremely structurally sound. So data points right there. I think 62% of housing, especially like where I live in Miami, are still cash buys. We still expect 3.53 million houses to be financed last year, and that's even what people are calling high interest rates, right, which is 6.5 to 7% right now. The big thing in the housing residential mortgage market is having a structurally sound mortgage product. And that means something that people can afford to pay. They're getting the things that make sense to them. And that keeps us out of that '02 to '08 era that we had where that didn't make a lot of sense. So from a data point perspective, the structure that I would say that what we see in a regulatory market the most is that you're very structurally sound, and therefore we expect a lot of good outcomes in the years to come.
Jeff, if you had to put an odds on it, what are the odds of Fannie and Freddie exiting conservatorship under a Trump administration?
I still have it very low. For me, I mean, and on the NBA board, we talk about that a lot. It's something that we're very active. I think it's very low. It's hard to put an overemphasis on how important it is to have that government complete explicit backstop on the residential mortgage market. So if you're going to somehow take away Freddie and Fannie and basically have the world bond investors believe that those two entities simply guaranteeing the mortgage bonds themselves is as good as the full faith of the United States government, to me, that's kind of hard to get my head around. So I think ultimately it'll be it'll be very low.
All right, going to leave it on that note. Jeff, thank you so much. So appreciate your time on this Tuesday. Happy New Year. Jeff Taylor, he's founder of Mphasis Digital Risk, joining us, just giving us some kind of insight into the housing market. I feel like it was a great back-to-back conversation because the housing market, that is like one of the major purchases for most Americans. So getting some insight into maybe what's to come next year. Although home builders, I was looking, haven't done much this year. They're down about 1%.
No, it's almost like, the market hasn't really taken that much of a position on it because, housing hasn't done so badly. There have been pockets of weakness for sure, but it's not been in the doldrums for sure.
Yeah, but